A lot of Australians might feel like they're doing it tough, but on paper, the economy's going gangbusters. Today's national accounts figures reveal the growth rate is double what the market expected, 1.3% for the first quarter of the year. It was hard to wipe the smile off the Treasurer's face, and Wayne Swan will be my guest in a moment. But first, political editor Chris Uhlmann cautions that the national economic story can't be told by a single number.
It's 120.95. Beautiful, thank you.
Things are better than you think.
They really were beautiful numbers.
The Coalition welcomes the extraordinary figure of the March quarter.
I think it was a very strong result, and it was certainly one that wasn't expected.
And this is a result that all Australians should be proud of.
Once every 3 months, the nation's economic pulse is measured in the national accounts. And overall, it's in rude health.
We are surging ahead.
Australia galloped into 2012 with the economy growing at 1.3% in the 3 months to the end of March. Over the year, growth was a heady 4.3%. To put those numbers in context, the long-run average for Australian growth each year is a touch over 3%.
Well, what they're actually showing is that the Australian economy actually was stronger than probably most people actually gave it credit for, at least in the first quarter of this year. The other thing that's come out of the data today is that that strength, or that resilience, if you like, was actually across a number of sectors of the economy. It wasn't down to just one particular driver. And that's important because it shows there is sustainability or breadth in this period of economic growth.
The national growth figure is double what the market expected, and some of the surprise came from households.
Because the strong bits of the economy were still strong. You saw it in mining, you saw it in the bits of construction that mining is dragging along, you saw it in Western Australia. That was great. But also in the areas that have been weak, that spending by families was stronger. We started to spend a bit more in retail and on cars, new cars as well. That combination was enough to drive genuinely very good growth in the opening months of 2012.
We saw good, strong growth in services sectors in the economy, and this is labour-intensive sectors of the economy. So this shows that it's not really a two-speed economy. I suppose it's better termed a three-speed economy. The middle leg is actually doing very well at the moment.
But the patchwork economy is revealed deeper in the numbers. Western Australia led the charge with growth in the March quarter of 7.8%, shading the Northern Territory. It's a long way back to the rest. The ACT growing just under 3%, with Victoria and South Australia both just under 2%. But the economies of New South Wales and Queensland contracted, and things were grim in Tasmania. The numbers do show that the benefits of the mining boom are being shared, albeit unevenly.
I think the majority of the positive news from the data today comes back to obviously the strong story about mining, but then I think through the filtering down of mining into other parts of the economy. And this is something that the Reserve Bank's spoken about previously, but to an extent has fallen on deaf ears.
But as the economy shifts radically, what's good for some sectors is bad for others.
The biggest problem with these figures is that one part of the economy is actually causing damage to another part of the economy. So the growth in the mining boom is actually forcing the exchange rate up, which is then contracting the manufacturing sector. What we're seeing is a strongly growing one part of the economy and a contracting in another part of the economy.
Despite the wrenching change and the difficulties it brings, the government does have a good economic story to tell.
Our economy's fundamentals are strong. We are seeing our economy grow, and I think these growth numbers today are proving some of the doomsayers and sceptics wrong.
The Prime Minister and the captains of mining still see the world very differently.
As a country and as an investment destination, arguably the biggest change has been the terms of trade, which is the impact on the currency and so on. But aside from that, all of the other things like increased operating costs, carbon taxes and so on have all conspired to turn this from a fairly low-cost environment and therefore competitive to a higher cost environment.
And today's beautiful set of numbers are only part of the story. Others add up to a headache for the government.
We've seen share markets being very weak, housing prices, it hurts capital gains taxes, it hurts superannuation taxes, and even more importantly, coal and iron ore prices are looking a bit sick. That hurts company profits and the taxes on them and the MRRT. Add that up and it says if the budget had to come down tomorrow, it would be back in deficit.
And for more, I spoke earlier to the Treasurer, Wayne Swan. Treasurer, how much of a buffer do these figures give Australia in the event of the Eurozone fracturing?
Well, these figures are broadly comparable with our forecasts that were contained in the budget. They're probably a little stronger, so that's a pleasant surprise, but nevertheless very consistent with our forecast for growth in 12-13 of 3.25%. I'm very pleased with the outcome here because it is broadly spread right across our economy. Strong consumption, broadly spread across the economy, strong business investment. A great outcome for Australia, and I think it's one that should give Australians great confidence in our economic fundamentals, particularly when we consider the challenges that we see in the Eurozone.
Does it mean that if we were to see, in the worst case scenario, another global recession, that Australia would avoid that?
Well, we've already factored in a contraction in the Eurozone of 0.75%. We don't react and I don't comment on hypothetical situations, but certainly in our budget figuring we took into account the fact there's going to be a very long adjustment in Europe.
But since you would have looked at the figures that you based your budget on, there have been some new figures showing a slowdown of growth in China, the US, India, Brazil. I think the threat of the instability in Europe has become greater. Back to my question, do you think global Australia is going to be poised to avoid that?
Well, I think we've got a proven track record of dealing with global instability. I think you'll find that in terms of our forecast for Europe, we were more pessimistic than many other forecasters. But you have posed a hypothetical situation. We would deal with that if that arose. I do expect that we will see further action in Europe, hopefully in the near future, by the European authorities to calm markets in particular.
Given the severe instability in Europe, why do you keep insisting that Australia will return to a surplus in 2012, 2013? Wouldn't it be more prudent to just keep maximum flexibility in your fiscal policy?
Not at all. You see, we should come back to surplus because we are growing at trend. We have a strong investment pipeline. But you see, a surplus sends a very, very clear message to the world and in particular to financial markets that finances in Australia are in good shape. And of course, coming back to surplus provides a buffer against global instability. I couldn't think of a better reason than those circumstances to come back to surplus to send a very clear message to the world that Australia is in good shape. And that's the great thing about these figures today, because they demonstrate very clearly that the economic fundamentals of the Australian economy are very strong.
But don't you think that the Australian people and investors around the world and observers would understand if you said, look, we are committed to bringing the economy back to surplus as soon as we possibly can, but given the great uncertainty in global markets, we are going to keep as much flexibility in our fiscal policy as we can and not get pinned down to some arbitrary date?
Well, Lee, I think for the first time in our history, we have now got the gold-plated AAA credit rating from the three major agencies, something the previous government never had. That's very important. I've also made the point that we do have a track record of dealing with global volatility and instability, and we've taken actions in the past when global demand has fallen off a cliff. But I'm not going to deal with hypothetical situations. What we are doing now is right for Australia in the circumstances we are in at the moment, and that is why international financial organisations and plenty of other organisations in the private sector give our approach a big tick. And these figures today demonstrate why that's very important.
You referred today to some people in the business community who from time to time talk our economy down. Who specifically are you talking about?
Well, I'm not getting into the business of naming names. The main people talking our economy down on a daily and hourly basis are, in fact, Mr Abbott and Mr Hockey.
No, but today you made that accusation about the business community. Why won't you name names if you're making that accusation?
Well, because I said the great bulk of the business community go out there and give very genuine commentary, but there are one or two in the business community who go out there and run the economy down all of the time. I don't propose to name names, but what I do want to do is make this point.
But why don't you want to name names?
Well, because I don't think it assists the debate. What I want to do is have a very clear conversation about the fundamental strengths of our economy, and it is not helped when we get a lot of commentary, some of it inaccurate, about those fundamental strengths, and in the media environment we are in at the moment, that gets exaggerated. The point I made today, and I'd like to make it again, is the glass is more than half full when it comes to the Australian economy. It's not half empty. The problem is we get a lot of commentary along those lines. It gets exaggerated in our daily media cycle, and it has an impact on confidence. And when Mr Hockey and Mr Abbott go out there and talk our economy down and then bemoan a lack of confidence, it demonstrates how insincere they are.
Well, let me ask you about some comments today by the BHP boss, Marius Kloppers, who said that governments need to do everything they can in this environment to keep Australia internationally competitive. In other words, be careful what taxes you implement. What do you say to that? Well,
let me say we are doing that. In fact, it was very interesting in the figures today was to see the productivity growth in the figures today, something like 2.4% for the quarter, over 5% for the year. Now, we are having a debate in Australia about productivity growth. We should have that. There's been a long-term structural decline in productivity growth in Australia. We do need to lift it. But when it comes to our underlying productivity, we're in the top 12 nations in the world when it comes to overall levels of productivity. And these figures show today that the productivity discussion needs to be more nuanced than it's been so far. So when it comes to competition and those issues, I'm engaged in those discussions with people like Mr Kloppers all of the time, and I value those discussions.
But when it comes to, say, the carbon tax, when that's implemented in July, Australia's going to have the highest carbon tax in the world. Isn't that what Mr Kloppers is referring to when he says we need to be very careful about remaining competitive in this international environment?
Well, I don't believe that the putting in place the carbon price is in any way going to make us dramatically uncompetitive. That's the propaganda of the Liberal Party. What we have done when it comes to those trade-exposed industries that are energy intensive is we've put in place assistance. We will continue to grow strongly with a carbon price. Jobs will continue to be created with a carbon price. Wealth will continue to be created with a carbon price. And indeed, these figures demonstrate that because since the carbon price has become law, we've seen investment continue, particularly into our mining sector.
On interest rates, given today's strong growth figures along with the volatility in Europe, isn't there a case for the big four banks not to pass on the RBA's rate cut this week?
I don't believe so. I believe that our banks are very profitable in terms of their return on equity. Net interest margins are back where they were prior to the global financial crisis. They say that their funding costs are up not so much because of international costs, but because of what they're paying for domestic deposits. The fact is they're very profitable, and I think they can well afford to pass that rate cut through in full.
But just last week, the Treasury Secretary told the Senate Estimates Committee that the coming crisis in Europe will primarily hit the financial sector. Don't we want to do everything we possibly can to ensure that our banking sector remains as strong as possible to withstand that hit?
Well, the government has been doing that, and we've put in place a whole range of reforms to ensure that our banking sector is strong. For example, the introduction of covered bonds, very, very important for our major banks in particular, but also some of our smaller banks and financial institutions. They've played a major role in securing finance for our banking system. The government has been very active in that area. We believe in a healthy banking system, but of course, our banks are very profitable, and I believe they do have the capacity to pass on this rate cut in full.
Treasurer Wayne Swan, thank you very much.
Thank you.